All right. Greetings to everyone. You're all welcome to today's session. Here is Pros and Cons Accountancy Tutorials, and my name remains Edward. As I always say, you can call me Ed for short, right? So we want to continue with the mechanics of consolidation as we began the last time. And we are dealing with our third mechanics, which is purchase consideration. So the last time we met, we talked about the group structure. We also made mention of the cash consideration and also the deferred consideration. Today, we want to look at contingent consideration and transfer of PPE. For now, we are aware that we have 6 types of consideration. One being the cash consideration, we have the deferred consideration, contingent consideration, transfer of PPE, loan consideration, and lastly, share exchange. So today, our focus is on contingent and transfer of PPE. I know some people have been asking of why didn't we post the figures when we dealt with the deferred consideration? Yes. So you have to know that the present value that we've calculated for the deferred consideration, it is a consideration. And again, it's also a liability that the parent is going to settle because we wanted to know the amount in present terms, right? As at the time of acquisition, what was the amount? So that's why we calculated for the present value. So that present value surely remains your consideration as at that time. And also it will be classified as what? A liability and therefore provision. So in your financial position, we can say is what? Provision, or we can name it deferred consideration. Then we add the unwinding interest also to it. So if we didn't deal with that, then I'm really sorry, but that's the clarification on that. All right. So now let's continue with contingent and transfer of PPE. First, we'll be looking at contingent. So we explained that for contingent, not different from deferred, but this is based on a particular condition. It is contingent on a condition. So normally, I am purchasing your company, but I will say that, okay, this is the agreement. I'm supposed to pay you this amount, but this amount, I will only give it to you if, let's say, the organization starts making profit. I will only give it to you if you start making profit. Or I will give you part of it if you start making profit. If you do not make profit. So let's say we have agreed on 20,000, right? Then we are saying that make profit by 31st December, and I'll give you all this 20,000. However, if by 31st December you are not making profit, then I'm not giving you the whole 20,000. I'm going to give you an amount of 15,000. So instead of giving you 20,000, because you did not make profit, I'm giving you an amount of 15,000. So there's a profit or a gain on bargain, which is now 5,000. Because I was supposed to give 20,000. Now I'm giving 15,000. So this 5,000 becomes a profit to me. It becomes a profit to me because in this case, the company, I was supposed to pay 20,000 in purchasing the percentage that I wanted to purchase. But now I'm giving them only 15,000 for that same percentage. So this 5,000 becomes a profit. It should go to the P or L. Though at acquisition, we knew the consideration, it was agreed to be 20,000. So that is what we are going to use as consideration at acquisition, right? But at the end of the time that we wanted to pay, it wasn't 20,000 anymore. It was what? It was 15,000. So in our P&L, in our financial position, we are going to show 15,000 as the contingent consideration. Same as we recognize the deferred consideration. We are going to recognize this 15,000 as the contingent consideration. But at the beginning of the year, what we will use as consideration is the 20,000. So let's always be careful on this. We will have a scenario to understand how the contingent consideration actually goes about. And this time around, we are going to post it in the financial statement for all of us to have an idea on the consideration. All right. So let's have a scenario and deal with this as fast as possible so that we can also deal with the transfer of PPE. So contingent consideration. So we want to continue with the same note as we used the last time. Now, additionally, Bruce has committed to paying an additional cash amount on what? December 31st, 2003, which is contingent upon Const achieving profitability by that date. So if Const is making profit by 31st December 2003, then Bruce is going to give them additional amount. And what amount is that? Now, at the time of acquisition, the fair value of this contingent consideration was estimated at what? 1,800. So at the time of acquisition, this is the consideration. We have to understand that this is the consideration that we are going to use at acquisition, right? Okay. However, due to ongoing losses, its estimated value as of 31st December 31st was revised downwards to what? 1,500. So at 2001, 31st December, the thing is no more what? 1,800. The consideration is no more 1,800. It will be what? 1,500 because Cons continues to what? Make losses. Remember this amount. This company, we purchased the company on what? 1st January 2001. And this payment, we say it is contingent and we are going to pay it on 31st December 2003, which is about 3 years, right? But even for the first year, at the end of the first year, we saw that, oh, they are still making losses. So the agreement, which was 1,800, it has now come down to what? 1,500. So Pros will now be making a profit of how much? 300. So for the first year, Pros is making a profit of what? 300. It can continue that. It can go on to the sense that the next year too, Pros will make another what? Profit, or Pros will make what? Loss. Why am I saying that? Because if they start making profit, this amount of 1,500 may go up in the second year. If they continue making losses, this amount of 1,500 may come down because Pros has only agreed that Cons should be making profit. That's the only way they are going to pay them an amount of 1,800. However, Cons is even making losses, right? So since Cons is making losses, Pros is saying that, hey, the fair value is now what? 1,500 instead of what? 1,800. So let's go and look at this on the board and post them in the financial statements. So the beginning value or acquisition value was estimated to be 1,800 cedis. And this is January 1st, right? 1st January 2001. But when we came to the year of the time of consolidation or the time of payment, or not, should I even say the time of payment? When we came to the end of the first year, right? End of the first year or reporting date. When we came to the reporting date, which is 31st December 01, it was now 1,500. So the difference is 300 Ghana cedis. The difference is 300 Ghana cedis. So Pros, at the end of the first year, Pros is not paying 1,800, but rather what Pros is recognizing in their account as a contingent consideration to be paid is what? 1,500 instead of 1,800. Remember this amount, it is agreed that the amount has to be paid 3 years time, 2003. Right? So for every reporting date, so they get to the 3 years time, Pros is going to recognize the fair value of that amount and see if the changes that has come. At the end of the report, at the end of the first year, which is the reporting date of the first year, 31st December, this amount has come down to what? 1,500. 500. And therefore, Pros is having a certain gain. We call it gain on bargain. Gain on what? Bargain. A certain gain of what? 300. And this 300 will have its effect in either the group retained earning or the P&L. If we are preparing the two statement, which is the P&L and the financial position, then this 300 will have its effect in the group retained earning and also in the P&L. Right. So when we go into our P or L, we are going to have a gain on bargain. A gain on bargain, which is coming out from what the contingent consideration of 300. Right. This same go to our group retained earning, which is our working gain on bargain. Also 300. But when we have our financial position, if we get our financial position now, Pros is going to recognize 1,500, right? Which is liability. Liability. So under liabilities, we will have non-current liability, which is as a result of contingent consideration. Contingent consideration of how much? 1,500. 1,500. So the agreed of 1,800 is now 1,500. This is what we will take to the next year because the time of payment is not up yet. It's 3 years time. So this is what we will take to the next year. Right? So if next year it still comes down again, yes, Pros is still going to recognize that gain again. Pros is going to recognize the gain in the second year if it should come down. Right. So basically, this is your contingent consideration. So what I want you to understand is that if you have a question, you don't need to panic. If it's a contingent consideration, that is the easiest, and you don't need to panic. Surely, the beginning value will be given out to you. So that beginning value becomes the consideration that you are going to use. Now, let us recognize our consideration, right? Our consideration that we are going to use at the beginning of the year is 1,800. So if you are preparing your goodwill, it is 1,800 that you are going to use to compare with the net asset schedule at the beginning. Always have that in mind because goodwill is prepared at the beginning of the year. We are not there yet, but please let me bring it in. Goodwill is prepared at the beginning of the year by comparing your consideration with that of what? With that of the net asset at acquisition. So if you do not know your consideration, how then do you prepare the goodwill account? Right? So for contingent consideration, always the acquisition value will be given. It's either they will give you an amount, let's say 3 CD per share, then you multiply it by the number of shares that you are buying, then they say that that's a contingent consideration. Right? It's a contingent consideration. Or a full amount will be given as the consideration, like it has been given here, which is 1,800. That is contingent consideration. The full amount has to be given, or a share price will be given for you to multiply it by the number of shares you are purchasing. Then you get your contingent, the fair value of your contingent consideration at acquisition. Now, you compare this with what will happen at the end of the year. Right? You compare the acquisition figure with the end of year figure. Whatever change that has happened, whatever change that has come becomes what? The gain on bargain that the parent will be having. And that gain on bargain will go to the P&L or P or L and also the group retained earnings. Now, whatever value which is given to you to be the reporting value is what you will use in the financial position. Because you can't use the beginning value again because it has changed. So we can't take that amount to what? To the financial position. That's acquisition what value. And at the end of the year, we want to know how much that value has either grown or reduced. Surely it is not going to grow because the agreement itself was the value at acquisition. So it is either the same or it will what? Reduce. Let's have that in mind. Contingent consideration Very simple. Let's actually have that in mind. Very, very simple. Normally, students find difficulty in this, but it is very, very, very bad. Simple. Very simple. Know the beginning value or the acquisition value, and also know the reporting value. Compare the acquisition value with what the reporting value. Whatever change, if it has changed, then it will be a gain to the parent, which will go to the P&L and the group retaining. If you are preparing the P&L or POL, you take it to what? The POL as gain on bargain. If you are preparing your financial position to, you take it to the group retaining as what? Gain on bargain. So very simple. And your financial position, the ending value or the reporting value is what you take to your financial position. I believe this is very simple and we do not need much to do we don't have much to talk about or much to say on contingent consideration. Right. Okay. So let's look at transfer of PPE. Transfer of PPE. So for transfer of PPE, it's like me purchasing your company and I decide that, please, I do not have money. So let me give you my calculator. This is my Macola calculator. I say, let me give you this, my calculator. Then you give me what? The shares, which is, let's say, agreed. Okay. So let's say transfer of PPE, sorry. So transfer of PPE. Let's say I'm giving you the calculator and I'm keeping that calculator in my book. So the carrying amount of the calculator in my book is 10,000, which means it's a very good calculator. So 10,000 in my books, right? But when I went to the market to find the fair value, the fair value was 14,000. The fair value was 14,000. And the consideration that we have agreed on is for me to give you what? 14,000. So the consideration was 14,000. Well, now, how much I'm keeping it in my book is 10,000. So that's how I'm keeping it in my book. So if let's say I'm supposed to give it out, I know it to be 10,000. But when we went to the market, it was what? 14,000. It was 14,000. So maybe I've gotten some I'm not paying anymore. So if not the fair value, I would have given you 10,000 as PPE and also add some cash of 4,000 to make it what? The 14,000. But lucky enough, we went to the market and it was what? And it was 14,000. The fair value was what? 14,000. So it is 14,000. And I'm not going to add any cash. So take your uh take the asset and give me the number of shares. So we are saying that since there has been a transfer of PP for which you were having it in your book as what 10,000, but on the day of transfer, the fair value, you check the fair value, it was 14,000. Then you are making a certain profit on that transfer of how much? You are making a profit on the transfer of 4,000. I'm making a profit on the transfer of 4,000. So you just give the asset, I'll just give the calculator to you, and that will be all. But in my mind, hey, this calculator was 10,000 power. Now it is 14,000. Hey, so in my mind, there's a certain profit that I've gotten on the asset to be what? 4,000. To be 4,000. So our consideration will be recognized as what? So we are going to debit consideration. Sorry, we are going to debit our consideration of what? 4,000. 14,000, sorry. Debit consideration of 14,000. What then do? We will credit the asset. You will credit what? The asset. You now have to credit the asset by how much? Remember, the asset, you were keeping it in your book as how much? You are keeping the asset in your book as 10,000. So how much are you going to credit the asset with? So in this case, then it means we will now credit the asset with what? So we will credit asset with 10,000 and also credit our PPE because we are getting a gain, right? We are getting a certain what? Gain. So our PPE, sorry, we will credit our profit or loss. We credit our profit or loss with a gain of what? 4,000. With a gain of 4,000. So this is debiting our consideration. Debiting our consideration. So that will equal the 14,000 of consideration and then 10,000 of assets and then 4,000, which is a gain. 10,000, which is a gain to our P or L or the group retain. But surely this has to happen in our P or L, right? So this is basically about the transfer of assets. This is basically what transfer of assets. So this is basically what transfer of assets is about. This gain will, as I said, will have effect in our P&L and our group retain earning. Right. Let's have a scenario. Let's have a scenario. So we have the scenario where we are saying an immediate transfer of a parcel of land will take place with a carrying amount of what? 17,000 and a fair value of 20,000. So let's go to our board and analyze this. We have carrying amount of 17,000 and a fair value of 20,000. So something which is 17,000. Now you have it to be what? 20,000. Well, it means if you are transferring, you will transfer it at 20,000, but not what? But not 17. So your consideration that you are transferring in terms of assets is 20,000. So you will debit consideration, debit consideration 20,000, and then we credit PP with how much? 17,000. Then we are also going to get a gain in both the P&L or let me say P or L or group retained earning of also 3,000. This is how your adjustment is going to be. So when we go to the when we go to the financial position, we just take out what? 17,000 from the PPE. 17,000 from the PPE. But for our consideration, this will be the consideration that we will use at the beginning of the year to prepare for our goodwill, to calculate for our goodwill. This 3,000 will have effect in the P&L because it's a gain for us, and it will also, we will credit it in the P&L, and also if we are preparing our group retained earning, we also have this 3,000 in the group retained earning because if the parent, as we said, the group retained earning is assumed to be for the parent, and whatever cost that the parent is incurring or expenditure the parent is incurring, and gains that the parent is what earning, we take or we recognize all in the group retained earning. So if there's this gain, then where are we taking it to? Surely we need to recognize it in the group retained earning. All right. So basically, this is how our contingent consideration and our transfer of PP is about. This is how its calculation is done. So in a nutshell, let me say for your contingent consideration, the beginning or the acquisition value will surely be noted. You will get to know the acquisition value and the reporting value. Just compare the acquisition value with the reporting value. The changes is a gain on bargain. If there's a change, if there's no change, then it means there's no gain on bargain, right? Now, when we go to your P or L, we are saying that this gain on bargain, we recognize it as a credit in the P or L. Now, your group retained earning will also have the same amount, right? To also have the same amount. Your consideration is calculated at the beginning of the year. So what was given to you at acquisition, that is it. That is your consideration. However, the liability, which is a non-current asset based on contingent consideration, is going to be the ending value, because the ending value and the gain on bargain together is what is giving us also the total amount at acquisition. So always let's be careful with that one as well. Very simple for contingent consideration. Now, when we go to the transfer of PPE, first thing that comes in mind is the current amount of that PPE. The current amount of that PPE and the fair value of that PPE, which has to be provided to you in a question, right? So you have the current amount and you have the fair value. Compare the two, right? Compare the two. Current amount, the current amount and the fair value, it is always the fair value that the person is going to transfer. So if the current amount is, let's say, 4 and the fair value is 5, it means if I should transfer the 5 to you, there's a gain I've gotten of what? 5,000. So if, let's say, the consideration has been agreed to be 5,000, however, I'm keeping it in my book as 4,000. So in my mind, I know that if I should give you that asset, I have to give another 1,000 of cash to you. We go to the market or we check the fair value and the fair value is 5,000. Oh, then I've made a profit. So what do I do? Or what I'm going to do is to do what? Give you that 5,000. But to me, there's a profit of 1,000. And that profit, what did we say? That profit has to be taken to the P&L or and also what? The group retain earning if possible. So surely that is very simple for contingent consideration and the transfer of PPE. So this is where we are going to end it for today's session. As I said, our focus was on purchase consideration, basically on contingent and then transfer of PPE considerations. Very simple. If you have any question, please don't hesitate to comment, and then we will surely reach out to you. We want to actually grow with you, so try as much as possible. Comment, let us all do with it together and then grow together as well. My name still remains Edward. Here is Pros and Cons Accountancy Tutorial. We are always glad to hear from you, and surely we know that we are going to you are going to hear from us again, and we are also going to hear from you. Please kindly subscribe to our page for us and make sure you share with others, like the videos, help us grow so that we'll be able to come out with more. Thank you very much for your time. And at this juncture, I say bye-bye.